academics have shown, just as an aside, that actively managed mutual funds underperform, meaning that when someone who's an expert goes in and tries their best to outperform the overall market and the overall economy, because of their activity, they end up falling behind.
Welcome back to Generational Sense, where we make sense of building generational wealth. I'm Nate, here with my dad, Brian.
Hi, Nate.
Hey. And today we're going to be diving into investing in the stock market. More of a broad video, kind of the basics of what I want of, what really are stocks, what's the stock market's purpose, that sort of thing. So excited to dive into this because this was something very vague to me when I, first left high school and started having maybe some extra cash that I could go into what people consider investing. And so it's like, well, how can we make my money grow when it's just sitting in my account? Investing in the stock market's a great way to do that, especially for retirement and things like that. So, Dad, if you want to break down for the people watching, what exactly is a stock and why do companies go the public route and use stocks for themselves?
Okay, so this feels almost too basic and maybe for some
Sure.
folks, but just starting out like yourself, we need to understand what a stock is. I know I've always had some, well, not always, but yeah, at one time when somebody would say bonds to me, I didn't know what a bond was and why
Right,
we
yeah.
would invest in it. So we'll just kind of break it down on a very basic level today, rudimentary level, about what a stock is versus some of these other investment vehicles that we need to be aware of, right? And so let's talk about stocks first. Stocks have been around since medieval trading periods, many hundreds of years ago. When the first companies came about, and these companies wanted a way of raising lots of money to build ships, to travel the seas, trade with big partners across this new world that was being discovered. So you had the creation of public ownership. And so what a stock represents is the ability for the public or for others to own shares in a company. Doesn't necessarily have to be a publicly traded company. There are, my law firm Clark and Bellamy could issue a stock, and in a way, we do have stock because we're a corporation, and so you can form any group can go out and form a C Corp and issue stock certificates and have small privately held companies. But what we're talking about are stocks where you, as a member of the public, can own a piece of that company. Now, some so-called institutional investors are large investors with lots of money and deep pockets. They may go out and buy so much of the company that they get a seat on the board of directors. In other words,
Yeah.
they're in charge of actually directing the future of that company and being a part of it because they own so many public shares. And that does happen. The Vanguards, Fidelities, and Schwabs of the world have become huge institutional investors, or the hedge funds, or the rich billionaires. So, but all that being said, that's what a stock is a share in the company.
Mm-hmm. Yeah, one of my favorite ways to kind of explain it is if you're a big fan of Shark Tank, they're essentially pitching their business to people, and those people are giving them money in order to own a part of that business. And so it's essentially the same thing, except for their investors. We're regular people. So we believe in that company or that group of companies. So we're giving them, our money in hopes that that company is going to grow and our share of that company is going to grow as well. So it's a pretty cool way to look at just the environment of money in general, because you can throw even a couple dollars, give to a company, and hope that if that company does well, your money's going to go up. So it's pretty cool. I do want to ask, I guess, for those who might not understand, of course, maybe outside of just the investment way where, like I just mentioned, hoping to throw that money there and hoping for a good return, what exactly is the stock market's function? Like, what's the purpose of the stock market?
Okay. Yeah. So these publicly traded stocks have to have somewhere to go to list themselves so that folks can come in and buy them. And so the stock market started out as a physical location where investors would come together and trade their shares for a price in these public companies. And then the brokers came along and said, okay, well, we'll handle going out on the trading floor and doing this for a group of clients who want to be able to buy and sell shares in these publicly traded companies. And now all of that is done electronically. And millions or billions or trillions or however many transactions that take place are happening via these electronic means every day. And the prices are still getting set by supply and demand, just on a much larger scale. And so the purpose of the stock market is to have a place to do that. And there are multiple stock markets around the world in different countries. In the US, there's a few major players. Everybody's heard of the New York Stock Exchange,
Yep, yep.
the NASDAQ, and the old American Stock Exchange out of Chicago. Some well-known exchanges where,
Right.
but nowadays what that represents is a company that manages all the behind-the-scenes computers and electronics and accounts and everything to be a middleman between the buyer and the seller.
Right. Yeah, absolutely. It's interesting too because if you have purchased a stock or something of that before, then you know that of course there's you have to purchase and actually you'll actually see that transaction in the actual time of the work day in a sense. So when the actual market's open and closed and so you'll see that kind of transaction during those times as well as when the market's closed that day or for a holiday, you're not going to see that transaction actually go until, it's back open. And it's kind of cool to think that, yeah, it's all digital now, but it's still people running that behind the scenes of the actual market. And that's, it's actually people dealing with that. So it's interesting.
Yeah, and there are ways nowadays to become involved in 24/7 fulfillment
Yeah,
of
yeah,
orders that you have. There's more volatility and sometimes more difference in buy and sell pricing. There's a gap, in other words, between what the sellers want to sell for and what the buyers want to buy for. And that can create some additional cost for the trade, not to mention the cost of the middleman, the platform
right.
handling the trades and those things. So, after hours trading is a thing, but for the most part, we're going to trade using those major exchanges during the hours that they're open and get our business done for intermediate or long-term investing.
Yeah, absolutely. So let's say we're getting some money together. We want to start investing, but you mentioned volatility and the fact that some stocks or some companies can be very volatile and they can be up, down, up, down. What are some factors that could drive those stock prices to go up and down maybe so consistently or, depending on the company pretty regularly?
Well, anything and everything. Just
Yeah.
this
I know it's a broad
past
question.
week we've had a yeah, just this past week we've had a volatile week because of politics. There are things going on in the world with regard to a new president, the imposition of tariffs, potential inflation. Numbers come out every day on earnings, and one company's earnings, like in Nvidia, they release earnings. It could affect 1,000 other
Yeah.
stocks because
Yeah.
if Nvidia's chip business is slowing down or speeding up, then what does that mean for the rest of the industry as far as the advent of, say, a new technology like artificial intelligence and what that's going to mean to new products and services and new efficiencies, new productivity. Every day there are things happening, and the buyers and the sellers are out there saying, well, in view of the world as the way we're seeing it, and in light of all the news of today, what's a fair valuation for these companies. And that then determines the stock value and what price it's set at. And we have new information every day. And so that's changing the way buyers and sellers see the world. And that creates volatility. And that's why stocks in general are not something that I'm going to come out and recommend individually stocks to any investor, anyone who calls themselves an investor, because news for that one particular company could easily cause that one company to face a headwinds that immediately causes a huge change in value that unless you, well, it just can't time because of that volatility and because of, the future of any particular one stock is so unpredictable. Investing means you get into a basket. And so maybe we can talk about mutual funds and ETFs and how those fit into the scene.
Yeah, absolutely. That was going to be kind of my next question. So I know I started out, many of us start out, we're very familiar with companies and the company names, and we look up, what's the symbol for that company? I'm going to invest in them because I know they're a good company that do well. But a lot of times that can be very volatile, like we just mentioned, and not really the safe route to do it. So it goes back to what we've probably all heard is, the higher risk, higher return. If I invest in this company because it's a little bit higher risk because it's just one company, I could have a huge return or I could have a huge loss versus putting my money in a bunch of stocks and that money, if one company goes bad and does something or something happens, my money's still fine because I've got my money in a bunch of other companies as well. So I know I kind of just broke it down a little bit, but maybe in some simpler terms and maybe better understanding from your perspective, what are some examples of different types of investments within the stock market that we can look into?
Well, first and oldest are mutual funds. Mutual funds came about 100 years ago and really provided a democratized way of investing for everyone to be able to pool their resources and buy more diversified selection of stocks. And the first mutual funds were actively managed, meaning that large companies that wanted to manage money would create this vehicle where they would go out and fill it with stocks that they thought were going to do a certain way to do well.
Right.
And so they would then fill the basket. And of course, there were a lot fewer companies 100 years ago than there are now. So, they would maybe choose the 30 largest or the 30 that they thought were the best. That created the Dow, for instance, and that created the Dow Jones Industrial Average, which is fairly irrelevant today because there's so many more companies and so much more diversity amongst, what's out there in the world of public companies and stocks. But a mutual fund was a basket of these. And then about 40, 50 years ago, some smart folks came along like John Vogel and with Vanguard, who founded Vanguard, and created index mutual fund, meaning the mutual fund itself was passively managed and that it was just going to go out and buy a basket of stocks based on a strict rule as to what would be in it. And one of the most popular of those is the total stock market. Having a mutual fund that attempts to replicate the entire market, every stock out there. And that provides so much diversity because then you're invested in international and small and large and undervalued and overvalued companies that are considered growth. And so you get all these different worlds. And that way, depending on what's happening with all of that volatility, you lower your overall volatility because of that selection of a diverse basket. And what you're really investing in then is the overall growth of the economy over the long haul. And for the past at least a couple thousand years, or all of human history, economies have grown and have had temporary setbacks.
Sure.
We don't, our best data goes back about 90 to 100 years. And during that time, you can look at any 20-year period and you're going to have a gain. And if you're well diversified in international and have some bond holdings as well, then I think you can even look at any 10-year period and find that you would have a reasonable gain. That outpaces what you can get through a safe government-backed investment like a savings account or a certificate of deposit. And that's the idea behind investing is you want to outpace the safe money by taking on some risk. And then the question becomes how much. And of course, when we're investing for something like retirement or college or to buy a house, then we don't want to take so much risk that it becomes truly a gamble, in that,
Yeah.
that one or two or 10 companies could cost us such a significant portion of our money that we're not able to accomplish our goals. And that's where mutual funds come in and provide that diversity by providing an entire basket of lots and lots of stocks, and preferably a basket that is passively managed and includes so many that you're extremely well diversified.
Right.
Academics have shown, just as an aside, that actively managed mutual funds underperform, meaning that when someone who's an expert goes in and tries their best to outperform the overall market and the overall economy, because of their activity, they end up falling behind. It introduces additional costs. It introduces additional gambles, you might say, and timing that cannot be done, the academics and the research shows. And so you're better off, if you're investing, being passive. Now, asset classes. Mutual funds will have different objectives. And so one might be to invest in small companies that are considered undervalued. Those would be small cap value companies. Another might be large caps that are undervalued. Another might be large caps that are considered to be high growth, meaning they tend to trade at a higher multiple of their price to earnings ratio. And so you can diversify amongst these different types of
Yeah.
asset classes. You can also diversify amongst sectors. Now, if you buy a broad-based index fund that's looking at the total market, then you're automatically going to have that. If you want to get more particular with it, maybe have 10% in the top 10 sectors, 10% energy, 10% tech, 10% real estate. You could do something like that and kind of control your diversity as well. And there's some research to indicate that that's a good idea as well. You
Yeah.
can get more sophisticated than just one big diversified mutual fund, but at the end of the day, you do want to invest in a big basket that's passively managed. And a mutual fund has democratized that and provided a way to do that.
Yeah, absolutely. I was going to mention on the sectors aspect of it too. It's almost a way to personalize it to you in a sense as well. You still have the basket to where you're investing in multiple companies and multiple investments. However, it's something that's more tailored towards an industry maybe you're interested in. Ideally, hopefully, look at the trends, see if it's a good industry to really
Yeah,
invest in. Say you're
yeah.
really into real estate, and you're keeping a close eye on those, and you're constantly looking at it regardless. That might be, a sector you want to look into putting more money into for you, because that's something you're going to pay more attention to, or something of that sort. So it's it's interesting to just kind of look at and see what else really out there. But I appreciate you kind of breaking down how it's not just necessarily those individual stocks, but those baskets of stocks, as well as the baskets within the baskets with large cap and small cap. And so
Mm.
it can get in depth, and it can get pretty confusing at times, but essentially, a kind of good rule of thumb that we've talked about a lot, just me and you, is having your money in long-term investments when it comes to stocks. So those bigger pots of money that you've got, like the education funds and retirement and things like that, where you're going to constantly kind of be putting money into. You're kind of betting on the entire market with those mutual funds, and if they're going to continue to grow, then you're most likely your money is going to continue to grow over time. So 30 plus years, when you're actually able to touch your retirement, it's going to be larger than it would have if you just had it sitting there in a savings account. Ideally, if the market continues to go positive. But so it's a very interesting just market, in a very interesting way to see your money and see kind of how it can grow kind of behind the scenes, just by putting looking into different things that you're interested in, and different companies, and just kind of throwing your money in the big pot to bet on the whole economy.
Yeah.
So
The great thing about your age is when the market's down, it's like shopping at a nice sale where
yeah.
everything is 20 or 30% off. And so you're buying low. And so then when that market recovers, you're going to be sitting pretty.
Yeah.
And, whereas in my case, if the market has a 10-year lull, I might not like that so much.
Yeah.
Yeah, it just, going back to one thing you said, you kind of indicated that maybe there'd be some interest in timing, what sectors you're in and that
Yeah,
kind of thing. And I would just, as a father to son, speaking some
sure.
generational sense, I would encourage you not to do that, but rather
Yeah, which
just
yeah.
maintain that diversity and look at being well diversified across all these sectors. And there's nice thing is nowadays with mutual funds, and we'll talk about ETFs briefly, is that you can do that with just one solid index-based fund
Yeah,
that takes care of all that dirty work for you.
yeah, absolutely. So, of course, we know the big way to make money on stocks long term or anything like that is hopefully having a gain on those stocks and actually being able to sell them for a gain. And so you win that investment in a sense. However, there's another way to kind of earn money on your investments, and those are dividends. Could you kind of break down what dividends are and
Sure.
what those could do for you?
Yeah, yeah. So let's say you've got Coca-Cola Company 1 and Coca-Cola Company 2. Coca-Cola Company 1 will pay you 3% interest on your money as well as any growth in the stock value. And Coca-Cola Company 2 says, nah, we're just going to keep all that money to ourselves from what we earn and reinvest it. Which one might you want to invest in? And so as you can see there, dividends are a way for a company who doesn't have anything great to do with their money to give some back to the shareholders. You might want to invest in Coca-Cola Company too, even though they're not giving you a dividend. Why? Because that means they think they've got something better to do with the money. So, what dividends are is a way of taking the profits that a company is making them and returning them through a set percentage that's determined by the board and everything to the investors. And it entices investors to continue investing in that company despite the fact that maybe there's not enough as much growth opportunity for that company. Apple Computer, for instance, for years and years did not have a dividend because they were investing in creating new products and this, that, and the other. And even though they had lots and lots of cash on hand, they weren't returning any of it. But then, as they got more mature, they had to think about returning some of those profits in the form of dividends. So now they do have a small dividend. So, um, mature companies arguably can be more stable.
Mm-hmm.
So if you want to have a source of income from the profits of those companies, then you can do that through their dividends. And your smaller growth companies tend not to have dividends because they're in a reinvestment phase rather than a stability and we're making good money and can't possibly reinvest it all, and so we're going to give some back to the shareholders.
Right. So thanks for breaking that down. So I'm curious, just from your experience, or maybe what you've seen a lot, what are some common mistakes that new investors should avoid as they are kind of looking into investing?
Ah, wow. So
I know
this,
this is a loaded question, but
yeah,
very
that's a
maybe
loaded question.
broad and simplistic.
I think for
Maybe
today,
some rules of thumb. Yeah.
yeah, I think for today, since we're kind of breaking down the difference between stocks and mutual funds and ETFs, I think that I'll just focus on like the number one mistake, and I think that is investing too aggressively in individual stocks rather than going with the wide net, the one or two strong index-based mutual funds or ETFs that give you an entire basket that's well diversified and then holding that for the long term. Another mistake that's close to that and very related is if you're investing for a very short time frame,
Yeah.
then again, you don't want to be too aggressive because, we could easily hit a time in the market where it loses 20, 30, 40%. And then, you've got something where you were setting that money aside to buy a house in 3 years or to buy a new car in a year, then you've lost 30% of your money. So you're better off for short-term needs, not investing in the stock market, but instead using something like ultra short-term bonds, which are very stable and less volatile, or CDs or a high
Yeah.
high return savings account that's FDIC insured. So I'd point those two out today. One, when you're truly investing, be well diversified and notice for the long haul, don't try to time the market because that's been proven to fail. And then short term, just don't invest in the market at all because you need those funds readily available to you when the time comes. Don't give up making some interest on that money, but and you can shop around like at bankrate.com, find the best interest on savings accounts and things like that.
Yep, I know many of us know the GameStop situation and stuff like that. You know, that's very rare, and it's not always a good thing when that happens. And so don't look specifically for opportunities like that because that's most likely most of the time going to end up in a negative stance for most people.
Yeah, and we folks like to play and have fun,
Yeah.
and I would argue, and this is not where I've always been, maturity wise and knowledge wise, but I would argue that money is something we shouldn't play with.
Yeah.
Money is something we should plan with. Money is something we should use strategically. We should think long term. We should think disciplined. And I think that's, if we want to even take a bigger step back and look at the big picture, I think that having the right attitude towards money and what we should do with it is important. Now I'm going to put all the cryptos and the day traders and
Yeah.
those, they're out of business. But if we have the right "I don't play with money" attitude, then that's where we land. Because there's just too much risk to play that. I think if you really want to play, then maybe what you want to do is be an entrepreneur and
Yeah.
play in the sense that you're out trying to start something that can grow very large. And that's a risk that you should still be well thought out, well planned, and do that business plan, do that due diligence. But at least then you're trying to do something productive and that's not just a guessing game and really just gambling.
Yeah. Well, and most of the time too, and just to add to that, most of the time if you're going out and you're putting that effort, although, a lot of businesses fail, most of the time at least, even if the business fails, you're getting something from it, maybe, just educational or something of the sense versus just putting your money basically in a gamble and you end up losing. And so it's you're at least getting something from it, even if you're not getting the return of money. But I completely agree. I think taking that money and investing it more in a business side of things than just trying to beat the market or something like that, then I think it's just a lot smarter way to go.
If you do that long haul, you're going to be the rich kid, man. So we haven't touched on ETFs, and I want to touch
Yeah.
on it because they're just about replacing mutual funds. I think this past year or two they've become more than 50%. I think they've crossed that line where they're more popular than mutual funds are.
Yeah.
And
Yeah.
nowadays you can buy the same index funds as an ETF. So for instance, Vanguard offers a total world fund, mutual fund that's symbol VTWAX. They also offer that same as VT, as an ETF. And ETFs you can trade just like a stock, and the price of that ETF varies throughout the day. Whereas a mutual fund closes out at the end of the day, and your
Yeah.
transactions don't take place until the end of the day. So ETFs have become very popular. They're slightly more tax efficient, arguably, than mutual funds are because they are treated by the IRS as stocks basically, and so you don't have trading within them the way you do with mutual funds, where you are. I mean, you do, but you don't have to. The IRS doesn't view it that way for you, so you don't have capital gains that will be reported at the end of the year if you're
Interesting.
holding an ETF long term, and you won't end up paying taxes on those capital gains. So because with mutual funds, they're constantly adjusting within the fund, and ETFs are too, but because they're treated differently, there's some slight increase in tax efficiency there and flexibility. They are more flexible, but there's where we have to be careful because it could tempt us into active trading when the market starts going down and we've got an ETF and
Yeah.
we can be like, oh, I can just sell that at any moment, and then you become an active trader. And like I said, academic research has proven that's a strategy that's prone to failure over the long term. So ETFs started out in the 90s. They've become very popular over time. There's more and more of them. Many of them you want to avoid because they're active within the ETFs themselves. They're just meant to make the companies that have been to create those ETFs money because they're actively traded or they're leveraged or they're all these fancy exotic things that, at the end of the day are just increasing your risk for no reason and are prone to cost you more and not only returns but also in just holding the ETFs cost you more
Yeah.
because of their increased costs. So yeah, just be aware that ETFs you want to choose carefully. Make sure you're choosing an ETF that uses the right type of strategy for long-term investing. And there's a bunch of good ones out there, but also a bunch to be avoided.
Yeah. And that's another thing I really think for all of what we're talking about today is just kind of learn what you're putting your money in, especially before actually just, oh, it's got a good growth. I'm just gonna click trade and buy some of it. Just look into it. It might actually be more interesting than you think of what companies are maybe in that mutual fund or that ETF or whatnot. I think that goes for pretty much everything here. Is just if you are, like I said, we probably bet against it. But if you are doing individual stocks, make sure you're paying attention to that company and what's going on with them. Or, same thing with the basket of stocks and companies. Pay attention to what's going on. It's pretty interesting when you look at it, especially when you see maybe if there is a big drop or if there is a big gain, why exactly. Look into it. It makes it a lot more enjoyable than just, okay, I've got that money sitting there and hoping it's growing. But I guess one thing I want to end on, just kind of a question for you. Are there any useful maybe resources or tools that you've learned for beginners that are good to kind of maybe continue learning about what they're actually investing in, other than, of course, this podcast?
Mm-hmm. Right. Well, I listen to some podcasts myself, and there's two that I would recommend that are consumer based and that talk about a lot about avoiding mistakes with money and also to some extent how to manage your money. Clark Howard has a podcast, and then a couple guys have a podcast called Talking Real Money that I really
Yeah.
enjoy, and they give very sound investment advice. There's another one, Stacking Benjamins, that involves some folks that do a really good job and provide sound advice. In fact, Clark Howard's podcast has recently started including a weekly episode by a fiduciary financial advisor. And so if you aren't able to go out and get the information yourself in a way that you can invest wisely, then considering hiring a fiduciary financial advisor is definitely something that you might want to consider. And nowadays you can do that through robo investing with a company like Wealthfront, where they will invest in a responsible way for you and automatically do things like tax loss harvesting, which could matter over the long run. Vanguard offers their digital advisor as well as higher level services. And so there are some fairly low cost ways to access fiduciary advisors. And then there's your traditional ones that you just have to be very careful about making sure that you select someone who is in fact 100% fiduciary all of the time. And
Hmm.
I can just tell you, if they're selling you anything, whether it be insurance or mutual fund or anything, where
Yeah.
then they're not acting as a fiduciary in that moment, which means you're probably making a poor decision. But yeah,
Be careful.
yeah,
Careful where you
be
put
careful
your
out there,
money.
folks. It's your money.
Yeah. Yep. Well, that's a wrap for today's episode of Generational Sense. If you did find this useful, don't forget to subscribe, give us a follow, and share it with someone else who may be interested. They're trying to learn investing or they're trying to learn what the stock market is and what they should be doing with their money. If you do have any questions or maybe topic suggestions, feel free to leave us a comment or reach out once again. And I thank y'all for listening in this week.
Great talk.
Great talking with you too, Dad.